What's up, everybody? A pause. It's not a pivot. Expect more volatility. We had a Wall Street Journal news article come out and the market rallied. But remember, the Fed is still tightening into a slowdown. In the Federal Reserve, the U.S. Federal Reserve, there's other central banks throughout the world that are tightening into a slowdown as well. We had also had news on Japan stages a new Forex intervention. Meanwhile, we had option expiration, and Wall Street is driving explosive volatility by YOLOing into zero-dated options. And the market roared. What a wild, wild day. You're watching the Stock Market Brief show. Now, remember, this is all coming on the back of just last month, Yellen saying that their markets were functioning well and, conditions were not disorderly. Well, I mean, if that's really the case, why are we already talking about reducing the size of the rate hikes, intervening, and seeing all this massive, massive volatility? Remember this chart here. As liquidity reduces, right? As liquidity comes out of the system, volatility increases. And we're seeing that, the red line being the S&P 500, the blue line being the Fed balance sheet. So how did Friday perform? Well, everything across the board was green. A big rally in the Dow Jones, 748 points. Meanwhile, also if you take a look at the correlation, everything was green other than a couple tiny little red spots, right? Verizon over there, highly, highly correlated. I'm not a fan of seeing this high correlation. The 10-year yield started off incredibly high on a massive gap up. And then all of a sudden that news dropped. Go figure. We'll see here if this rates want to start to back off a little bit. Meanwhile, TLT got its head smashed in, coming to the lower part of this channel. Are we going to potentially see a bounce here? Is the bottom in? Look, we might see a bounce. Yeah, it's definitely. I'd be very careful playing a bounce here, right? You got to be very tactical. Make sure your positioning sizing is on point. But other than that, there is no reason to believe that a bottom is in right here on the TLT. You actually need to be very careful here, because if the TLT does start to rally hard and the S&P 500 comes off, this will look more like a safety trade, and it hasn't been a safety trade, right? Bonds are down significantly more than the S&P 500. Now, the bulls are going to hate this, but here's the reality of the situation. Despite seeing a big rally, we haven't gone anywhere for, over a month? Yeah, we've been in a chop box, ladies and gentlemen, going back and forth and back and forth and back and forth. Now, futures, right? It's Sunday. Futures are opening up. Looks pretty green so far. I wouldn't get too caught up on the futures market, right? Low liquidity, and we could see wild swings, so we'll see how that plays off. But are we going to be breaking out of this chop box? Obviously, and we'll talk about how I plan on trading this, right? We talked about that in the prior episode, itching to buy. This is heading into a silent week of the Fed, so we're going to have a whole week with no Fed talk. And then on top of that, we have the biggest earnings week coming up. What can potentially go right? What could potentially go wrong? A lot could go right. A lot could go wrong. It seems pretty binary, but we got on deck Microsoft, Alphabet, or Google, Visa, Meta, MasterCard, Amazon, Apple, and Chevron, to name the bigger market cap players. So Tuesday, Wednesday, Thursday, Friday, smack, smack, smack. Okay, big stuff taking place. Now, if we take a look at what caused that rally, what is the market pricing in? Well, you can take a look at the Fed watch tool, which is looking at the probability of rate hikes. We still have a 95% probability that we're going to get a 75 basis point hike, right? It goes from 300, which is target, 300 down to 375. So we're going to get another 75 basis point hike. And have we actually seen this settle into the markets yet? I don't know. Now, come December, what took place? What was the difference? Well, this used to be a lot higher. Okay, so this came off, and the market now is pricing in the potential for a slowdown in the rate hike. So from 300 where we are now, we'll get a 75 basis point in November, and then a potential 50 basis point is what it's saying. Or potentially less. Sorry, a 50 basis point would be over here to go to 425. But the probabilities of another 75 basis point have slimmed down. However, it's still around 50-50, so we'll see what happens. You can really see the difference here, right? So on the probabilities of what can potentially happen, look at how this one shot up. So the probabilities of a reduction in rates went up, where an increase in rates obviously went down. So it'd go from it'd be a 50 basis point here, went up, and then 75 basis point here obviously went down. But this changes on a daily basis, so we'll see. Continue to monitor, continue to play carefully. In the grand scheme of things, if we just zoom out, let's take a look at the monthly and the quarterly expected moves based off of implied volatility. Okay, we talked about this at the beginning of the month, at the beginning of the quarter, actually, and I even shared these levels and everything. If you haven't seen it, go back to watch that movie or join up for my Patreon, because I posted there too. Now, first and foremost, we had a huge down month. Boom, this one, right? Remember September? Of course you do. We closed at the low of the month, and now we're getting a little bit of a rally. Now, what do we do? The same thing when we're over here. We said, hey, the 5 EMA is declining. It's very likely, it's the most frequently tagged EMA, it's likely to see a reconnect at some point. Well, what did we do? We reconnected with it, and everyone screamed for joy, and they're like, haha, it's over, and then crash, right? The Fed came back out. What are we doing right here? Well, the markets are getting wild, and all we're doing is pointing straight back up to the upper monthly expected move to right around where the bear market is, still down over 20%, right? That's the red shaded area that's measuring from peak to trough, okay? So, and I'll explain why, like last episode, I was more bullish and more bullishly inclined to take long positions, which I did, right? I got some exposure, all right? Now I'm sounding off the alarms just to do not, I'm seeing on Twitter, too many people are getting way overly bullish, and I think that they're becoming overly bullish, but they're not exactly telling what their position size is. Like they might be incredibly bullish for a melt up and all this crazy stuff, but you got to understand, they might only be positioning themselves 15% long in their portfolio, right? Because they think that we're going to get some crazy move to the upside. They want to catch some of that, which is totally responsible, right? That's totally fine. That's how I'm looking at it. But a lot of other people might see that and might be like, go all long, let's leverage long. We're going to get a huge move. And then you might not get the move that you expect, and it could become quite tragic of a move. Now, as far as upside potential, look at the 5 monthly EMA. It's at 3856. We've been talking about that 3800 to 3900 level. Well, that's also in confluence with the upper monthly expected move. If you take a look at the Qs, same situation. It's coming back into a declining 5-period EMA. And yes, we do still have wind at our face on both the charts. Now, let's layer this on with the VIX. The volatility index is still relatively high. We had some suppression come out, right? Why? Well, we had OpX, right? So volatility came out and it's coming to its lower Bollinger Band. And if you pay really close attention, you can see here, remember I always talk about contraction to expansion, and then expansion to contraction and so forth, right? Things contract and they expand. Well, this Bollinger Bandwidth, right? This is right here, boom, Bollinger Bandwidth. This is measuring the width of the Bollinger Band, and as it heads lower, which it can always head lower, that means the Bollinger Bands are getting tighter, right? Contracting. So what happens after they contract? Well, they expand. How tight will they get? Well, I don't know, but I can look back through history and say, hey, we're coming back into an area that we've only seen a few times. Actually, this is the tightest the contraction has been in all of 2022, okay? And that, by the way, that doesn't mean that it can't, expand to the downside. I'm not saying that. And then also right here, and then right here, and then right here. So what happened when those tight contractions took place? Well, we saw rocket ships in volatility. Is that what's going to happen here? I don't know, but be aware that if we do get an expansion in volatility, right, whether it's to the upside, which let me reiterate this too. A lot of people think that when volatility goes up, right, when volatility fires off to the upside, it means that the S&P 500 goes down. That's not necessarily true. All right, we saw that actually on Friday. Remember, and other people will be like, see, that's why you shouldn't call it the fear index. Okay, no, you got to understand, when volatility goes up, that is what's creating the fear. It's not because the S&P 500 goes down or up. It's because the volatility and the swings on a daily basis become insane, and that's what creates the fear. Okay, so yes, volatility is still at around 30, which means what? We can still see around 2% moves on a daily basis. That is something to fear, right? That is wild swings that can obviously break things, excluding portfolios. If we take a look at the weekly time frame, we are bouncing back up from the inclining 200 weekly moving average. All right, we're still overall in a downtrend, right? Boom, boom. So if we get some monster rally, is it going to take out this June rally from this bottom over here? That would probably come into what is from this low 3,400 to 4,000. What kind of percentage gain is that? What, like about a 20%, something like that? Come up into that area. That was about the amount of the rally this was. And guess what? In bear markets, we see 20% rallies, especially if you just go back to the financial crisis, right? You don't need to go back that far. If we take a look at the NASDAQ 100, it's creeping back above that 200 weekly moving average. This is kind of interesting to me. Dow Jones Industrial, right? It's back above it. Still inclining, so that looks good. It was a very strong week for the industrials, 4.89%. But if you take a look at transports was mediocre, right? It's kind of like it's flagging right now. So a couple of things. If we do get a rally, hey, perhaps this has some more room to squeeze up versus the other products. But you got to understand this too. If these come off and the Dow Jones Industrial continues to rally, that's actually not a good sign. You could actually look side by side here as the Dow Jones Industrial average is running back above its 10 weekly period moving average. This one actually got rejected at it. So if this actually continues to decline and hold, and this breaks down like a bear flag, I wouldn't expect the Dow Jones Industrial Average to hold much longer. Why? Well, because if you take a look at the Dow Jones Composite, it's made up of what? 3 different products, right? The industrials, the transports, and the utilities. And as you can see here, they are diverging. And now you don't need to worry about this divergence like right now, but if it goes on for weeks and it persists for weeks where you see like, the industrials go up, but yet transports aren't making another high and utilities aren't making another high, that right there it's a negative divergence, and they typically will come back into correlation at some point. Okay, so they move hand in hand for the most part, and if they don't, pay attention, right? And that's what we're seeing right here in a short period of time, right? I'd like to see this, 3 weeks or more. But that I just wanted to call out. S&P 500, let's take a look at the weekly expected move. We're looking at 3866 for the upside, 3639. I will have a picture at the end of this video to show you. Okay, now that would bring us to where? Well, that brings us to right around that 3900, 3800 level. That's what we were talking about. Now, if I zoom in, right, everyone's calling this an inverse head and shoulder, so everybody sees it. Every technician sees it. It's not a big thing. It's whatever. We are below a 200-day moving a 200-period moving average. This is a 65-minute time frame. We're above a 5-day inclining now moving average. Where can we potentially break if we start getting above that 3,000 level, 3,800? I would start paying attention to that. Once again, upper weekly expected move, and then 3,900 up into this area. And the reason why is because you can just look back. There is a supply drop right over here, right? Broke down, came back to us, and just fell off of cliff. It acted as support over here, and it also acted as resistance and support over here. So this level is, it's like a magnet point over here where price continues to just bounce from. So yeah, to see price come up here, be aware that if you're catching a rally, this could be a good level to potentially take some off the table or potentially look to fade. It just depends on what price looks like if it gets up into that area, okay? This was the chart that we shared on the prior video, breaking out of that channel. I looked at a couple long positions. Got a little bit of exposure. So am I long? Yeah. Am I short some other names? Yeah, I run a long short book. That's what I do. Okay, so yes, you can get some potential exposure. It is kind of flagging right here. This is the NASDAQ composite. And we might break out to that 50-day declining moving average. The overall trend, once again, it is bearish, right? Don't try to call a bottom. Just pay attention to the volatility. Understand that anything and everything has happened and can happen, okay? It can get wild and wicked out there, so be very careful. But yes, big day. I want to go back to the 15-minute time frame on the SPY just to give you a little bit more clarity here. These aren't the type of moves, if you're not long, that you really want to chase. The futures market looks like it could press even higher, but we'll see where that opens up. But you want to wait for a potential pullback, right? You want something to, set itself up, where it gives you a better risk to reward. So, you'd have your stop loss here, and then you would enter over here on a breakout, or whatever the case may be. Maybe it comes up and, fires off like right out of the gates to 3,800, and then it starts pulling back. Even there, you'd still want it to do something where it flags, or wherever you can back your risk into to feel a little bit more comfortable. So if price starts to break down quick, well, then you can get out of the position with not worrying too much about it. Now, understand, the more violent the move, the less you should probably trust it. So just be aware. Right, that's what bear markets do. On a good note, we have the buy and sell signal. It's still pointing down. It caught a little bit of a move to the upside, the CPC, but it still hasn't crossed down through that 0.95, which I like to see. And when we see that, we typically get a few more days of some bullish activity. Right here, it kind of came down and then shot off again. So we'll continue to monitor that. And then obviously we've been watching the summation index. Well, remember, it ticked over. That was day one of the tick over. And now we're starting to get some sort of a rally. Okay, it is well below zero. Okay, but I will say that, hey, this could mark a potential change in trend. It doesn't mean that it's not going to be really volatile, and also doesn't mean that it can't chop back and forth like this. But we've seen the trend change here, and we saw the trend change here. The last trend change from a bullish perspective was where? It was right here. The market went down a little bit, but then we caught a huge bear market rally. Now, if we take a look at the zones, this is the last thing that I want to touch on, something that I share with my Patreon group, which is $9 a month, or just pay annually, which is a little bit better. You save 16% when you do that. It ends up being like $7 a month. So it's like $90, and you get access to trade ideas, weekly expected moves, and that compiles a list of I don't know, like 40 different names. I do the work there. I give zones right now. I don't list it in here because I'm still using them. I'll probably put it in here eventually, but I'm trying to hone that in a little bit. The zones are basically a good risk management tool. It allows you to see potential upside and downside. It's based off of math by Benoit Mandelbrot, off of one of his books called Bridge Band Indicators. If you take a look at the community tab over here, we have a lounge, memes, intraday, and all this good stuff. Now, what I want to pay attention to is where the upside and downside is in some key products. So S&P 500 and VIX are obviously two big products. Upside, 1.72%. So it's already reaching to its upside, and that's in saying that we have some, obviously, more downside. So as we continue to move higher, understand that from a fractal perspective, that the risk to reward is now the reward would be more to the downside than the upside. It doesn't mean that this is a probable outcome. This is literally just helping identify better risk management. Okay, VIX, we have a 14% upside. I mean, the low end here is at 28.14. The high end is at 34. All right, it's pretty wild. So that's 14% move higher versus 5% move lower. And even if it hits the lower range at 28, right? These are dynamic; they're always changing. But that is still relatively high, which means that the market can still see massive swings. And then another thing here is obviously the 10-year yield. The 10-year yield, right, works from an intermarket perspective on a lot of products. If you see here, upside versus downside. That means that, hey, there's actually quite a bit of downside building, which rates, if they start backing off a little bit, might perpetuate a move to the upside. And you can even take a look at stuff like TLT, right, which is the bonds. Upside is 8.36%, downside is 1.12%. So you're probably seeing people underneath to them where they're not looking at this stuff. They're saying, oh, now it's time to like play a bounce in bonds. Well, they're probably understanding that it's just a heavy move to the downside and it could catch some sort of a relief, okay? So that is what they're looking at right there. What else do I want to call out on this? Not much, but those are the main key things. I guess the dollar would be another main product to watch. Upside is actually growing here. Okay, 2% upside to 1% potential downside, where the downside is 110 and then the upside is 114. So right now the dollar's in some sort of a consolidation. It backed off, right? I didn't even share a chart here, but remember, it's really just going sideways right now. We had a pretty bearish looking daily candle. So if we get continued downside, that might help the markets perpetuate higher, and we might start to see a continued rally as the dollar backs off. Now, if the dollar backs off, I would always expect to gold to potentially rally too, as we saw a little bit of a bump up in gold, right? GLD, we have 3% downside, 3.5 and 3.6. So upside downside is, a 1-to-1 ratio, which means we're just sitting there basically in the middle of the zone, 154.15, right? 154.24. There you go. That's all I got for you on today's episode, everybody. Hope it helped out. See y'all later.